Coca-Cola is a company that many investors turn to when the markets are getting volatile. And the reason for that is that the company has a very long track record of steadily growing its stock price as well as its dividends. Coca-Cola is actually granted the title of a dividend king, which means they have been increasing their dividends steadily over the past 50 years non-stop. Now, over the past year, the company is up by almost 30%. Now, most people would have a look at this graph and think that the company must be overvalued as it's currently more expensive than what it was on October 10th, 2023. But the simple truth is that the company might have been overvalued in 2023 and currently might actually be undervalued. Now, to understand whether a company is actually under or overvalued, we have to look at its financials, which is what we will do in today's video. But before we do that, there's one metric we can have a look at to understand whether the company might or might not be trading below its intrinsic value. And that is the PE ratio. So let's have a look at the comparison of Coca-Cola stock price to its PE ratio. So I will select the PEGAAP and update the chart. And we can see that the PE ratio has actually been rising over the past year. And when the PE ratio rises, it means that the company has to spend more capital to generate revenue. And that is, of course, something that is driving down the intrinsic value of the company. And so when the price of the company is rising, while the PE ratio of the price of the company is rising as well, it is hinting towards that the company might currently be actually overvalued. But to figure out with certainty whether Coca-Cola is under or overvalued and whether you should be thinking of buying the company at its current price, we'll jump over to our stock valuation spreadsheets. And here I will plug in the ticker KO and all the metrics will show up automatically. And of course, as always, if you want to download these spreadsheets, you can do so at my Patreon in the link in the description. Now, when we plug in the ticker of Coca-Cola, right away we can see that the beta is sitting at 0.6. And that is what I've been saying before. Coca-Cola is a very stable stock, which is almost 40% less volatile than the S&P 500, meaning that many investors flock over to it when the markets get volatile. And that was also the reason why its stock price has grown so much over the past 3 months, as the market was very volatile and many investors wanted a safe place to invest into, so they invested into Coca-Cola. Now we will jump over to our first pillar out of the 9 pillars we will be looking at today, and that is the 5-year PE ratio to be sitting below 22. So the average stock PE ratio is sitting at 22.5, and as we want our companies to be above average, we want their PE ratios to be below 22. So we can see that over the past 5 years, Coca-Cola's average PE ratio has been growing by about 2.14% year over year. We can see that in 2019 it was sitting at 27.34 and currently it's sitting at 28.87. So the 5-year PE ratio of Coca-Cola is actually sitting at 26.26, which is not below the value we want to see. So Coca-Cola actually gets a cross for the first metric we are covering. Now what I also want to do is calculate the intrinsic value of Coca-Cola. So we will jump to our Graham's formula, which is one of the metrics, which is one of the valuation methods, one of the 4 valuation methods actually we use to calculate the intrinsic value of a company. And this method takes the earnings per share and multiplies it by the sum of the base PE and the multiple of the 5-year growth estimate and the growth rate multiplier. Then it multiplies everything by the average yield on A corporation bonds, which is sitting at 4.4, and divides it by the current yield on A corporation bonds sitting at 4.21. And this gives us an intrinsic value of $52.12, which is actually 36% lower than the current trading price of Coca-Cola. Now jumping to the second pillar, which is the price to free cash flow over the past 5 years. And the price to free cash flow is very similar to the PE ratio of a company, except that the price to free cash flow, the free cash flow of a company, is very hard to manipulate. And therefore it is a more reliable metric to look at when trying to find how much capital the company has to spend to generate revenue. Free cash flow is also the main engine that drives a company's development. As with free cash flow, a company can buy back shares, they can invest it back to the business to grow it, they can also pay down debt, and free cash flow is also used to pay for dividends. So personally, I trust the price to free cash flow much more than I trust the PE ratio, as that is the actual engine that drives a company forward. In this case, we want the price to free cash flow over the past 5 years to be below 21. As we can see, the free cash flow of Coca-Cola has on average been increasing by about 9.5% every single year, which is not a good sign. And over the past 5 years, the price to free cash flow is actually on average sitting at 24.93, which is about 4 points higher than what we'd like to see. So again, for the second metric, Coca-Cola gets a cross. Now, every value investor will tell you that the most important thing for a company is its growth. And therefore, for the next three metrics, we'll have a look at the revenue growth, the net income growth, and the free cash flow growth of Coca-Cola over the past 5 years. So jumping back to pillar number three, which is the revenue growth of the past 5 years, we can see that Coca-Cola has been growing their revenue by about 5% every single year, growing it from 37.3 billion in 2019 to 45.7 billion in 2023. We can see the steady trend of growth on the graph below. So this is a clear tick for pillar number three. Now moving to pillar number four, we can see that Coca-Cola has been increasing their net income by about 4.5% every single year. Again, we can see the nice trend upwards on the graph. So this is a tick for net income growth as well. And finally, to pillar number five, the free cash flow growth over the past 5 years. The free cash flow has been growing by about 2.5% every single year, which is slightly lower than our net income growth and our revenue growth, but it is still a positive growth. So Coca-Cola again gets a tick for pillar number five. Now, something I'm not liking that much with the free cash flow growth is that we can see that the free cash flow growth has actually been decelerating over the past 5 years. And by this I mean that it has been growing less in percentage year over year over the past 5 years. So this is something we want to look out for. Now, I also want to calculate the intrinsic value of Coca-Cola based not only on its PE ratio, but also on its free cash flow. And that's where we start using the discount cash flow analysis model. So we take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at 4.95. The analysts project a growth of 4.59% into the future, and I will calculate a growth rate of 5% over the next few years. Now, using the calculated growth rate, I calculate the future free cash flow, and then using the discount rate, which I will plug in at 6% based on the WACC of the company, I will calculate the present value of that future free cash flow, which is the value accounting for inflation, and then summing up all of that future free cash flow, adding any cash and cash equivalents, subtracting total debt, I will get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $70.27, which is only slightly lower than the current trading price. So based on the company's historical and future free cash flow, the company is currently trading right at its intrinsic value. So now that we have calculated the intrinsic value of Coca-Cola using the discounted cash flow model, we can move to our sixth pillar, which is the 5-year profit margin to be above 15. Now the average stock profit margin is sitting at 15, so obviously we want the companies we invest into to be above average. And we can see that the 5-year profit margin of Coca-Cola is actually sitting at 23.66, which is well above the average stock profit margin, so that would be a tick for Coca-Cola. Now, even though this is a tick for Coca-Cola, if we have a look at the current profit margin, it is sitting at 22.92, which is lower than the average 5-year profit margin. And so we can have a look at the profit margin graph just below, and we can see that the average profit margin has actually been decreasing over the past 5 years. In 2019, it was sitting at 23.94%, and currently it is sitting at 23.42%. Of course, in 2022 and 2021, the profit margin was fluctuating, but overall we can see that it is decreasing, though it's decreasing very slowly, so it's not anything I will freak out about, but it's something I will keep my eye on. Now moving to our third valuation model, we want to compare Coca-Cola to companies which operate in the same sector, in this case PepsiCo and Monster Beverage. So I will take these two companies' stock prices and divide by their earnings per share to get their PE ratios. I will then average out these PE ratios to get an average PE of 27.82. Now taking into account that the higher the PE ratio, the less effective the generation of revenue for the given company. And so if the PE ratio of the two companies is high, when we multiply by the earnings per share of Coca-Cola, the intrinsic value of Coca-Cola will be higher as the PE ratio for the two compared companies is high and therefore not as effective. On the other hand, if the PE ratio was low and we multiply by the earnings per share of Coca-Cola, the intrinsic value would come out very low as the PE ratio, as the two companies we are comparing Coca-Cola to, were more effective in generating revenue than Coca-Cola. I really hope that what I just said makes sense. But anyway, the intrinsic value of Coca-Cola comes out to be $68.43, which is only slightly lower than the current trading price, hinting towards that Coca-Cola might actually be trading at its intrinsic value right now. But now let's move to the seventh pillar of the analysis, and that is the decreasing shares outstanding. So when evaluating a company, we ideally want the company to be buying back shares, as that means that as an investor, you own a larger percentage of that company with time to come. And as we can see, Coca-Cola has actually been increasing the number of shares outstanding by about 0.16% every single year, which honestly isn't that bad. Plus, we can actually see that they have been decreasing the amount of shares over the past 2 years, so they are on a good track, but we still have to give them a cross. Now moving to the eighth pillar, the consecutive dividend growth pillar. Now as Coca-Cola is a dividend king, which means that they have been increasing their dividends every single year over the past 50 years straight, it is quite clear that they have been increasing their dividend over the past 5 years. And so this is a clear tick for Coca-Cola. But there are still a few metrics I want to have a look at. So the current dividend yield of Coca-Cola is sitting at 2.76, which is quite higher than the average stock dividend yield of the companies in the S&P 500. The dividend payout of Coca-Cola is sitting at almost $2 per share per year, and their 5-year dividend growth is sitting at 3.4% year over year, which is slightly lower than the average year over year dividend growth. But as Coca-Cola is a dividend king, this is quite expected. Now, another important metric to evaluate is the 5-year free cash flow payout ratio, which is sitting quite high at almost 80%. And what this means is that Coca-Cola pays out 80% of their free cash flow in dividends. So they're only left with about 20% of their free cash flow to buy back shares, pay off debt, and invest back into the company. And this is actually directly linked with our ninth pillar, which is the long-term liabilities over the 5-year free cash flow negative dividends to be below 5. And what this pillar essentially does is look at if the company is generating enough free cash flow to cover their dividends and to pay off their long-term liabilities without getting into any issues. So we can see that the long-term liabilities over the 5-year free cash flow negative dividends for Coca-Cola is sitting at 4.08, which is lower than our wanted number, which means that the company can pay off all their long-term liabilities who are paying out their current dividend in about 20 years, which earns Coca-Cola a tick. Now looking at the chart below, we can see that in 2019, Coca-Cola actually took on a lot of debt, going from their long-term liabilities sitting at $36 billion to $49 billion. Now that we have finished the 9-pillar analysis, let's jump to our fourth and final valuation model, which is the dividend discount model. And here we will evaluate the company based on its dividends. So we'll take the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 2.43%. Now into the future, I predict a very similar growth rate of 2.5%. And using the projected growth rate, I will calculate the next year's dividend, which when we combine with the discount rate sitting at 6%, which we already plugged in our discounted cash flow model, we will get an intrinsic value of $53.89, which is about $20 lower than the current trading price. But now let's jump to our ultimate valuation, where we will average out the four valuations we did in between our pillar analysis, and we will get an intrinsic value of $66.50, which is 5.5% lower than the current trading price. And if we plug in a margin of safety of say 5%, now normally I would plug in a higher margin of safety, but as Coca-Cola is a well-established company that isn't going anywhere anytime soon, I will plug in a margin of safety of just 5%, and plugging that in, I will get an acceptable buy price at $63.18, which is still about $7 lower than the current trading price. Now, before we draw any conclusions, let's quickly jump back to the 9-pillar analysis. And we can see that 3 of the 9 pillars are in the red, from which 2 are the 5-year PE ratio and the price to free cash flow. Now, as Coca-Cola is a well-established company that isn't going anywhere anytime soon, many investors are willing to pay a premium for the company, and so they are willing to pay more for the company's earnings and for their free cash flow. And so currently pillar number 1 and pillar number 2 aren't really that big of an issue for me, as it is quite clear the company will be trading more expensive than other companies which aren't as stable as Coca-Cola. Now, regarding the third pillar in the red, I don't have a big issue with that one either. That is the decreasing shares outstanding. Coca-Cola has only increased their shares outstanding by about 0.16% over the past 5 years year over year, which isn't that much at all. And over the past 2 years, they have actually been decreasing the shares outstanding, which is great. And based on Coca-Cola's Q3 investors presentation, they are planning on keep repurchasing shares into the future. So overall, it is quite clear that Coca-Cola is a very healthy business. I just wouldn't buy it at its current trading price, as in my opinion, it's trading above its intrinsic value, and I think that it will go lower over the next few months. With that, thank you for watching, and let me know down in the comments which company you'd like me to evaluate next.